I think this inflation story is real. It's going to be a big driver of markets. Thematically, it's going to be a big driver of what the Fed does, what the Bank of Canada does. So I know it's not necessarily a fun one to be talking about, but we at least want to unpack it, make sense of it, and give you an idea of where we think things are headed here. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It's Friday. Bit of a mixed week in markets, so we're going to get into that. Definitely a bit choppier this week. We've got some inflation data to talk about. World Cup update. We'll leave that to our FIFA correspondent here, Greg Wise. But how you doing? How you doing today, Greg? What's going on?
Yeah, it's all good. I don't know. You've been watching a lot of soccer too, it seems. So I think you can hang with them in terms of the updates and all that stuff. But it's been fun to watch for sure. Moving on from the group stage, a lot to look forward to.
Oh yeah, soccer very very different from rugby, which was my sport, and hockey. Hockey, which I spend a lot of time at now, but no, it's good to watch. It's fun to see. We came close against Switzerland, but we're on to the next round, which is exciting.
We're on to the next round, which is exciting, and it's just interesting the way things work out. We actually probably have a little bit more of a favorable matchup just by the way things worked out than if we were to win the group. So in a tournament like this, you need a few lucky bounces here and there, and I think Canada might have got one, but no game is easy, so it should be a fun one on Sunday.
Yeah, Canada might be hoisting the World Cup before the Leafs win a Stanley Cup. The way things are going here, but we'll see. We'll see.
Yeah, exactly. I wouldn't put it past it at this point. Who knows? But it'll be fun.
Oh yeah. So looking forward to getting into things here today, Greg, and we wanted to kind of build on what we talked about last week and what we were unpacking the story on the real economy and hard assets and real assets and sort of the shift or potential shift we're seeing in the market under the hood. And what's interesting this week is probably the big headline and the thing sort of slowing markets down is we're seeing some inflation prints that are coming out higher than expected. And that sort of not so nice word, inflation's coming back, which I think a lot of investors thought for a long time that it pretty much had gone away, and the way the world had gone, inflation didn't exist. And we've seen in the last 5 years or so post-COVID is that inflation's real. It's a real risk. It's a very, very major driver of markets, and we're starting to see it return to the conversation and the numbers. So we wanted to talk a little bit about inflation. Maybe not the most fun topic, but it's certainly an interesting one.
Yeah, it's certainly topical. The narrative within the last month or so has really shifted from the war in the Middle East, as that's calmed down, shifted more towards inflation. And within the last couple weeks or so, we had Canada's inflation number come out at 3.2%, which I think was higher than expectation. And then, we had the U.S. number come out, I think just north of 4%, which it hasn't been that high in over 3 years. So it seems, Will, that inflation is very much back and into the mix here.
Yeah, and if you look at the chart as well of where the month over month numbers, it was really spring of 2021 the last time we saw inflation rising like this, and then we got to the 3-4% range, but then it quickly went up to high single digits, 8-9% in the US and Canada. So obviously a lot of market implications there. And I think one of the things I had mentioned last week is once inflation starts getting into the system, starts getting into the economy, I made the joke that it's in the carpet, it's in the seat cushions. It's tough to get out of there. And I think that's what we're seeing is we still have the post COVID inflation, but then we have new drivers. So the recent one is, of course, oil prices and war in the Middle East, but you also have to think that all the tariffs and all the disruption that we've seen the last couple years across the globe, that's going to do it, and just the general reshoring, reindustrialization, nationalization that's going on is for years and years production was being outsourced to low cost producers, and everything was about globalization and doing it at the lowest possible cost. Now what we're seeing is this drive and trend towards nationalization, which you bring things in from a lower cost to a higher cost place. It's driving up prices. So I think this inflation story is real. It's going to be a big driver of markets. Thematically, it's going to be a big driver of what the Fed does, what the Bank of Canada does. So I know it's not necessarily a fun one to be talking about, but we at least want to unpack it, make sense of it, and give you an idea of where we think things are headed here.
So inflation, at different time periods, it comes up for different reasons. But is the reason, Will, we're seeing it now? Are there a few different factors as opposed to maybe just one single reason why we're starting to see the uptick in inflation?
Yeah, I mean, I don't think it's just the oil prices and the war in the Middle East. I think it's a lot of fallout from the last couple of years, and I think it goes back to even COVID. Is that supply chains being disrupted, uh, world being turned over. They're just directionally the way the geopolitics and the way countries are going and economies are going. We're not. We're moving to a different sort of world where there's not just one center of everything, and things are being spread back out. And I think there's just a lot of forces at play. And 2022 is a very good playbook to look at, I think, for this market that we're in now. Not to say we're necessarily in that phase, but if you look at that period of 21 and 22, where you had the post COVID technology boom, but then you also had inflation creeping in and interest rate concerns. And I've said before, the more historical, maybe more dramatic way to look at it is the late 90s, early 2000s, or even go way back to the 70s. And I think it's looking at, okay, what sort of portfolios, what sort of positions worked in that environment. 2022 is probably the more recent and relevant example, anyways. But if we're headed into that type of environment, what sort of strategy, what sort of portfolio, what sort of position worked? And that's ideally where we'd want to be aligned with.
So just given that, Will, it seems that we're kind of heading into that direction where inflation is running a little bit hotter than expected. It's jumping up maybe a little bit faster than everyone would like. But given that, how are we thinking about portfolios and overall positioning right now?
Well, I think the thing to remember about what gets hit the hardest, and we're seeing that say this week or this month, and more recently, as it is the technology side of it. So I do think that inflation, interest rate scares are one of the things that can take that steam out of the AI trade and the technology and that whole long duration growth trade. And again, not that you want to be out of that entirely in your portfolio, but when you look at those areas of the market, they've done incredibly well. There's incredible growth there. You want and need low interest rates, stable environment to support that growth, and those growth assets, technology, long duration assets. When interest rate bond yields start to go up, inflation expectations, the potential for interest rate hikes, those areas of the market get hit the hardest. And that's what we saw with the NASDAQ in 2022. And again, not that there was an incredible opportunity, but it was something like 35, 40% decline in the NASDAQ peak to trough that we saw in 2022. And other areas of the market start to pick up that slack, and investors rotate away in those inflationary environments into other areas and other pockets, which we talked about a little bit last week.
Yeah, so value being one of them, more TSX correlated assets as well. I guess, Will, with inflation, is the reason the markets in general just don't like it is because that basically means inflation. The Federal Reserve is going to have to pivot from lowering rates to maybe keeping rates higher for longer, or actually potentially increasing interest rates.
I mean, for sure, all of the above, right? Inflation is just not something that tends to be friendly for markets and for growth. It's not good for bonds either. I mean, it's eating away at purchasing power. That's why the target, and it's funny because it's been a bit of a moving target, especially since COVID. But the target should be and has been 2%, but it's now become a little bit of a moving target where we're not sure if central banks can get it down to those levels. But yeah, I mean, there's certain assets that are going to be inflation hedges, and we talked about real assets and hard assets in the real economy. So businesses that are in the physical economy that are more value oriented as opposed to growth oriented, meaning that they're not priced on future cash flows and earnings like a SpaceX. They're priced much more on current cash flows and earnings, and businesses that pay dividends, and a lot of these more traditional sectors, whether it's industrials or financials or the energy or materials, those sorts of areas, infrastructure assets tend to do a lot better. And just look at the 2022 playbook in terms of what performed and what didn't. Bonds tend to not perform particularly well. I mean, we haven't been constructive on long bonds in years and years, probably since the bond market peaked when interest rates went down to near zero or near zero in COVID. But bonds do not do well in an inflationary environment. So there's assets that hold up better, and that's where they tend to be. That's where we've been more focused, not entirely, but certainly where the focus for new money and new assets have been is on those real assets, those hard assets. And I think in this potentially inflationary environment, that's where you want to be positioned.
Yeah, and in 2022, as an example, Will, there was a huge difference between the performance of the TSX as an example compared to the Nasdaq. So obviously with our process, just trying to make sure we're gearing towards what's working, as much as possible. A question for you that I want to pose to you, just with cash. So we're in a higher inflation type environment. If there's folks with cash on the sidelines, is this the time to be, looking at keeping big stacks of cash on the side, or is it the time to say, you know what, inflation is potentially eroding purchasing power to actually do something with that cash?
Yeah, I mean, look, it's going to depend on what your investment objectives are and what that cash is there for. I wouldn't be too worried about inflation chewing away at this point. I think more what we find is that you start to get a little bit of more negative news in the markets, like we're seeing now, and people can wait with money that has long-term objectives or long-term investment objectives and want to sit on the sidelines and wait forever. What we found, just clients from a behavioral standpoint, is sitting with all that cash, waiting for the perfect time to deploy it. I don't know if I've ever seen it work. It rarely works, if ever. Most times if markets do correct and pull back, the situation is worse, and investors don't want to turn around and deploy that cash because the news flow and the sentiment out there is more negative, and it's tough to go against the grain. On the other hand, if you're holding cash back and you're waiting, and markets and portfolios continue to grind higher, then you sit back waiting, not waiting for that correction. So I think what you want to look at with cash is, what are the long-term objectives? How does that fit into my overall portfolio, my overall investment plan, my financial plan? How do I align that and be invested in the portfolio and the process for the long term overall? But yeah, too many times we've seen cash hanging back. And the other thing I'd say, yes, inflation's going higher, but even look at 2021 as we referenced that. markets went significantly higher for months and months after that. It probably took another year for the markets to shake out and really see a decline. So just because inflation numbers have gone higher here doesn't mean that the market's all of a sudden going to turn over and go through a major crash or correction or market event here.
And just because inflation's getting a little bit higher, or even if interest rates go up, it doesn't necessarily automatically mean the markets are going to crash. Like we've seen at different times where inflation has crept higher, interest rates have gone up maybe a little bit more gradually than 2021, 2022, and there's still opportunities to make money. So the Federal Reserve comes out and raises interest rates once or twice through this next little period, that I don't think that automatically means things are just going downhill from here.
No, probably more of a rotation, I think, especially as you see since the end, like this quarter, second quarter, the NASDAQ has increased dramatically in terms of just size and how much money's in there. And we're coming up on the first half of the year. So even if it's just a rotation out of some of those NASDAQ long duration names into more of the value names in other pockets, other areas of the market, that's all it's going to take for a little bit of a correction. So that's where we look at it and say, okay, where's the value? Where's the opportunity? It may be just much more of that rotation or that shift in terms of asset classes. And there's so much. I mean, if you were to compare market capitalizations of growth pockets of the market versus these more value, real asset, hard asset type areas, it's dramatic. So, I mean, I don't think it will take a lot. We're seeing a little bit of that today or in the last week or few weeks for there to be a rotation away from growth into value, into those other pockets of the market. And I think that's what you start to see in these types of environments.
Yeah. So, Will, we're about halfway through the year. What would be your message to investors, kind of on the first half, but also the second half, and maybe just how they should think about things going forward?
Yeah, I think this market, you want to be in those right sectors, those right areas, those right pockets of the market. I don't think it's going to be unchecked growth and AI and technology going to the moon here. I think we want to be well diversified, well positioned for this market cycle, this changing market cycle, this potential rotation that's gonna happen. And that doesn't mean being out of tech entirely. I know we've lightened up tech over the last 6-8 months or so and have taken some of the NASDAQ and the Mag 7 and the tech exposure off the table. Certainly not all of it, and have tried to focus on the leadership names. But you really want to be positioned in those right areas of the market and looking more towards the future, where things are going in this market. And just because we're starting to see these signs out there of inflation and potentially higher interest rates doesn't mean don't be invested. I think what it means more so is think about repositioning, shifting and adjusting portfolios based on these changing conditions towards the right assets, the right sectors, the right names, and get that positioning right. And if you've got that, especially on a relative basis, a portfolio is going to weather through any sort of environment. So that's what we're working to do, is have much more of an all-terrain type of strategy that's going to carry through, navigate through any sort of market environment, have the right positioning, tactically shift and adjust based on changing market conditions to weather whatever's going on out there.
Yeah, and in this environment, Will, it's obviously a little bit more choppy, this environment, but I would say that longer term positioning is more important than just kind of the day trading, trying to move off of the headlines that you're seeing out there.
For sure. So we stick with the process, stick with the strategy here overall, and ultimately we want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. So we'll be back with everybody next week, and we'll talk with you soon.
Have a good one.